Catherine, a 34-year-old restaurant owner, was seeking help with her business taxes when she encountered an accountant that would test her knowledge of legitimate tax preparation and teach her valuable lessons about tax return fraud targeting small business owners. The accountant promised to maximize her deductions through aggressive strategies that could trigger audits or penalties. Catherine's family restaurant had been struggling with complex tax requirements, and she needed professional assistance to ensure compliance while minimizing her tax burden through legitimate business deductions and strategies. The accountant, Robert Chun from Maximum Refund Tax Services, specialized in small business taxation and claimed expertise in finding deductions that other accountants missed, promising to save Catherine thousands in taxes through aggressive strategies. Ms. Rodriguez, most accountants are too conservative and miss valuable deductions that could save your restaurant thousands of dollars, Chun said with apparent tax expertise and deduction maximization knowledge. Maximum Refund Tax Services specializes in aggressive tax strategies that push the limits of tax law to minimize your business tax obligations. Chun explained that his aggressive approach involved claiming maximum possible deductions for business expenses and using creative interpretations of tax regulations that conservative accountants avoided due to lack of expertise in advanced tax strategies. Ms. Rodriguez, conservative accountants leave money on the table by not claiming legitimate deductions that require advanced tax knowledge to implement properly. Chun continued with apparent advanced strategy expertise and conservative accountant criticism. My aggressive approach ensures that you pay the minimum taxes legally possible through sophisticated deduction strategies and regulatory interpretations. Chun promised to reduce Catherine's business tax liability by at least 40% through aggressive deduction claims and offered to guarantee his results by paying any penalties if his strategies were challenged by tax authorities. Catherine was interested in reducing her tax burden, but was concerned about aggressive strategies that might violate tax regulations and result in audits or penalties that could harm her business. I want to minimize taxes legally, but I'm worried about aggressive strategies causing audit problems, Catherine explained to Chun. Can you ensure that your approaches are completely legitimate and won't create compliance issues for my restaurant? Chun became dismissive about Catherine's audit concerns, claiming that aggressive tax strategies were completely legal and that his guarantee protected clients from any potential consequences of advanced deduction techniques. Ms. Rodriguez, my aggressive strategies are completely within tax law boundaries, and my penalty guarantee ensures that you have no risk from advanced tax planning. Chun insisted with apparent legal compliance knowledge and risk protection assurance. The IRS rarely audits small businesses, and even if they do, my guarantee covers any penalties or additional taxes from my strategies. Chun also claimed that conservative tax preparation was costly for business owners and that aggressive strategies were necessary to compete effectively with businesses that used advanced tax planning to reduce their obligations. Catherine felt pressured by Chun's competitive claims, but decided to research tax preparation standards and verify the legitimacy of aggressive tax strategies before implementing approaches that seemed risky. Catherine contacted the IRS to research legitimate business tax deductions and learned that aggressive tax strategies often involved questionable interpretations that could result in penalties, interest, and audit problems for business owners. Catherine also researched Chun's credentials and discovered that he was not a certified public accountant or enrolled agent authorized to represent clients before the IRS, making his penalty guarantees meaningless. Catherine realized that Chun was promoting potentially fraudulent tax strategies that could expose her business to significant penalties and compliance problems while lacking proper credentials to provide legitimate tax representation. Catherine contacted Chun to decline his services, but Chun became aggressive and claimed that Catherine was missing opportunities to save thousands in taxes through advanced strategies that conservative accountants couldn't provide. Catherine reported the aggressive tax preparation practices to the IRS and her state's Board of Accountancy. She learned that tax preparation fraud often targeted small business owners with promises of maximum deductions through questionable strategies. The authorities explained that legitimate tax preparation involved conservative interpretation of tax laws and proper credentials, and that aggressive strategies promising guaranteed results often involved fraudulent or questionable practices. Catherine worked with a legitimate certified public accountant who provided conservative tax preparation with proper deduction documentation and compliance assurance, avoiding potential audit problems from aggressive strategies. The experience taught Catherine to verify accounting credentials and be suspicious of aggressive tax strategies that promised guaranteed results while potentially violating proper tax compliance requirements. Catherine now educates other restaurant owners about tax preparation fraud and emphasizes the importance of working with properly credentialed accountants who prioritize compliance over aggressive strategies that could create audit problems. Marcus, a 41-year-old construction contractor, was managing his business finances when he encountered a bookkeeper that would test his understanding of legitimate record keeping and teach him valuable lessons about embezzlement schemes targeting business owners. The bookkeeper was stealing money while manipulating financial records to hide the theft. Marcus had hired a bookkeeper to manage his construction company's financial records and had noticed some inconsistencies in cash flow that didn't match his project income expectations, making him concerned about potential record-keeping problems. The bookkeeper, Sarah Williams, had been managing Marcus's business finances for 8 months and consistently provided financial reports showing reasonable expenses and cash flow that seemed to match his business operations. However, Marcus began noticing that his business bank account balance was consistently lower than expected based on completed projects and client payments, despite Williams's reports showing appropriate income and expense levels. Ms. Williams, my bank balance seems lower than expected based on the projects we've completed, Marcus explained during a monthly review. Can you help me understand why the cash flow doesn't match what I would expect from our recent work? Williams became evasive when Marcus questioned the cash flow discrepancies, providing complex explanations about seasonal business patterns and unexpected expenses that seemed designed to confuse rather than clarify the financial situation. Mr. Thompson, construction businesses have complex cash flow patterns with seasonal variations and unexpected expenses that can create temporary discrepancies between project income and available cash. Williams insisted with apparent construction industry knowledge and cash flow expertise. The financial reports show all income and expenses accurately, and the bank balance reflects normal business operational costs. Williams also claimed that questioning financial records could interfere with proper bookkeeping procedures and that Marcus should trust her professional expertise in managing construction company finances. Marcus felt uncomfortable with Williams's evasive explanations and decided to review financial records independently to understand the discrepancies between expected and actual cash flow. Marcus began comparing his project income records with bank deposits and discovered that several client payments had been deposited but not properly recorded in Williams's financial reports, suggesting potential theft or manipulation. Marcus also found that Williams had been writing checks to vendors that didn't correspond to actual business expenses and had been manipulating expense categories to hide unauthorized payments and cash withdrawals. Marcus realized that Williams was embezzling money from his business by manipulating financial records to hide unauthorized payments and cash withdrawals while providing misleading financial reports that concealed the theft. Marcus confronted Williams about the financial discrepancies, but Williams claimed that the records were accurate and that Marcus was misunderstanding normal bookkeeping procedures for construction businesses. Marcus terminated Williams's employment and hired a forensic accountant to analyze the extent of the embezzlement and document the theft for potential legal action and insurance claims. The forensic accountant discovered that Williams had stolen approximately $45,000 over 8 months through various schemes including unauthorized checks, cash withdrawals, and manipulation of vendor payments and expense records. Marcus reported the embezzlement to local law enforcement and his state's Board of Accountancy. He learned that bookkeeper embezzlement was common among small businesses that didn't maintain adequate financial oversight and internal controls. The authorities explained that legitimate bookkeeping involved transparent record keeping with clear documentation and that business owners should maintain independent oversight of financial records and bank reconciliations. Marcus implemented stronger financial controls, including dual authorization for payments and regular independent review of financial records to prevent future embezzlement and ensure proper oversight of business finances. The experience taught Marcus to maintain independent oversight of business finances and to investigate discrepancies immediately rather than accepting bookkeeper explanations that didn't align with actual business performance. Marcus now educates other contractors about embezzlement prevention and emphasizes the importance of maintaining financial controls and independent verification of bookkeeper activities to protect business assets. Jennifer, a 29-year-old nonprofit director, was preparing for an audit when she encountered a consultant that would test her knowledge of legitimate audit preparation and teach her valuable lessons about audit fraud targeting nonprofit organizations. The consultant offered to help manipulate financial records to pass the audit while charging excessive fees. Jennifer's nonprofit organization was facing its first independent audit, and she needed professional assistance to ensure proper documentation and compliance with auditing standards and nonprofit financial reporting requirements. The consultant, Michael Torres from Nonprofit Audit Solutions, specialized in helping nonprofits prepare for audits and claimed expertise in ensuring audit success through comprehensive record preparation and compliance strategies. Ms. Patterson, nonprofit audits can be challenging for organizations without proper preparation, and audit failures can threaten funding and nonprofit status, Torres said with apparent audit expertise and nonprofit compliance knowledge. Nonprofit Audit Solutions ensures audit success through comprehensive record preparation and strategic presentation of financial information. Torres explained that his audit preparation services involved organizing financial records, preparing documentation, and advising on presentation strategies that would ensure favorable audit outcomes and protect nonprofit funding sources. Ms. Patterson, audit preparation requires strategic organization of financial records and documentation to present your nonprofit in the most favorable light. Torres continued with apparent strategic presentation knowledge and favorable outcome expertise. My experience with nonprofit audits ensures that potential problems are addressed and that auditors receive properly prepared financial information. Torres quoted a fee of $8,500 for complete audit preparation services and suggested that some financial records might need adjustment to ensure compliance and avoid potential audit findings that could threaten nonprofit status. Jennifer was concerned about Torres' suggestion of record adjustments and wanted to understand whether his preparation strategies involved legitimate compliance assistance or potentially fraudulent manipulation of financial information. I want to ensure our audit preparation is completely legitimate and ethical, Jennifer explained to Torres. When you mention adjusting records, can you clarify whether you mean proper documentation or actual changes to financial information? Torres became evasive when Jennifer questioned his adjustment suggestions, claiming that audit preparation involved complex compliance strategies that required professional expertise to implement properly without compromising nonprofit integrity. Ms. Patterson, audit preparation involves sophisticated compliance techniques that ensure proper presentation of financial information according to auditing standards. Torres insisted with apparent compliance expertise and auditing standard knowledge. Record adjustments involve proper classification and documentation rather than changes to actual financial data. Torres also claimed that questioning audit preparation strategies could interfere with successful compliance, and that Jennifer should trust his professional expertise in nonprofit audit requirements. Jennifer felt uncomfortable with Torres' vague explanations and decided to research legitimate audit preparation requirements and verify proper compliance procedures before implementing potentially questionable strategies. Jennifer contacted other nonprofit directors and learned that legitimate audit preparation involved organizing existing records and ensuring proper documentation rather than adjusting or manipulating financial information. Jennifer also researched audit standards and learned that any suggestion of manipulating records to pass audits constituted fraud and could result in serious legal consequences for both the consultant and the nonprofit organization. Jennifer realized that Torres was suggesting audit fraud by proposing to manipulate financial records to ensure favorable audit outcomes while charging excessive fees for potentially illegal services. Jennifer contacted Torres to decline his services and inform him that she would pursue legitimate audit preparation through proper channels. But Torres claimed that her approach would likely result in audit problems. Jennifer reported the audit fraud consultant to her state's Board of Accountancy and the IRS Nonprofit Compliance Division. She learned that audit preparation fraud often targeted nonprofits with promises of guaranteed audit success through record manipulation. The authorities explained that legitimate audit preparation involved proper documentation and organization of accurate financial records rather than manipulation or adjustment of financial information to influence audit outcomes. Jennifer worked with a legitimate certified public accountant who provided proper audit preparation assistance through record organization and documentation without suggesting any manipulation of financial information. The experience taught Jennifer that legitimate audit preparation involved transparency and accuracy rather than manipulation, and that consultants suggesting record adjustments to pass audits were likely proposing fraudulent services. Jennifer now educates other nonprofit directors about audit preparation fraud and emphasizes the importance of maintaining accurate financial records and working with legitimate professionals who prioritize compliance over audit outcome manipulation. David, a 36-year-old medical practice owner, was reviewing his practice finances when he encountered an accountant that would test his understanding of legitimate expense management and teach him valuable lessons about expense reimbursement fraud targeting medical professionals. The accountant was submitting false expense claims while managing the practice's financial operations. David had hired an accountant to manage his medical practice's complex financial operations, including insurance billing, expense management, and financial reporting, trusting the professional to maintain accurate records and proper financial controls. The accountant, Lisa Martinez, had been managing David's practice finances for over a year and consistently provided financial reports showing reasonable operational costs and expense patterns that seemed appropriate for medical practice operations. However, David began receiving unusual bills and notices that suggested expenses had been charged to his practice that he didn't recognize or authorize, making him concerned about potential unauthorized financial activity. Ms. Martinez, I'm receiving bills for expenses that I don't recognize or remember authorizing, David explained during a financial review. Can you help me understand these charges and ensure that all practice expenses are properly authorized and legitimate? Martinez became defensive when David questioned the expense charges, claiming that medical practices had complex operational requirements and that all expenses were properly authorized through standard practice management procedures. Dr. Wilson, medical practices involve numerous operational expenses including supplies, services, and professional fees that are essential for practice operations. Martinez insisted with apparent medical practice knowledge and operational expense expertise. All expenses are properly documented and authorized through established practice management procedures. Martinez also claimed that questioning expense management could interfere with efficient practice operations and that David should trust her professional expertise in managing medical practice financial operations. David felt uncomfortable with Martinez's dismissive response and decided to investigate the unusual expenses independently to ensure that practice funds were being used appropriately. David began reviewing expense documentation and discovered that Martinez had been submitting false expense claims for personal purchases, travel, and services that were not related to legitimate practice operations. David also found that Martinez had been using practice credit cards for personal expenses and manipulating expense categories to hide unauthorized purchases while providing misleading financial reports that concealed the fraudulent activity. David realized that Martinez was committing expense reimbursement fraud by using practice funds for personal expenses while manipulating financial records to hide the unauthorized spending from practice oversight. David confronted Martinez about the fraudulent expense claims, but Martinez claimed that the expenses were legitimate practice costs and that David was misunderstanding normal medical practice operational requirements. David terminated Martinez's employment and hired a forensic accountant to analyze the extent of the expense fraud and document the unauthorized spending for potential legal action and insurance claims. The forensic accountant discovered that Martinez had fraudulently claimed approximately $28,000 in unauthorized expenses over 14 months through various schemes, including personal credit card use and false expense reimbursement claims. David reported the expense reimbursement fraud to local law enforcement and his state's Board of Accountancy. He learned that expense fraud was common in professional practices where accountants had access to credit cards and expense reimbursement systems. The authorities explained that legitimate expense management involved proper authorization and documentation of business expenses, and that professional accountants were required to maintain clear boundaries between personal and business financial activities. David implemented stronger expense controls, including prior authorization requirements and regular independent review of expense claims to prevent future fraud and ensure proper oversight of practice financial operations. The experience taught David to maintain independent oversight of expense management and to investigate unusual charges immediately rather than trusting accountant explanations without proper verification. David now educates other medical professionals about expense reimbursement fraud and emphasizes the importance of maintaining financial controls and independent verification of accountant expense management activities. Patricia, a 43-year-old retail store owner, was preparing her business tax returns when she encountered an accountant that would test her knowledge of legitimate tax compliance and teach her valuable lessons about sales tax fraud targeting retail businesses. The accountant suggested underreporting sales to reduce tax obligations while keeping the difference. Patricia's clothing boutique had complex sales tax requirements due to online and in-store sales across multiple jurisdictions, and she needed professional assistance to ensure proper compliance with sales tax regulations and reporting requirements. The accountant, Kevin Johnson from Retail Tax Specialists, specialized in retail business taxation and claimed expertise in minimizing tax burdens through strategic reporting and compliance approaches designed for retail operations. Ms. Garcia, retail businesses can significantly reduce tax obligations through strategic sales reporting that takes advantage of regulatory complexities and audit limitations, Johnson said with apparent retail tax expertise and strategic reporting knowledge. Retail tax specialists help store owners minimize taxes through sophisticated compliance strategies that most accountants don't understand. Johnson explained that sales tax compliance involved complex regulations that allowed for strategic interpretation and reporting approaches that could significantly reduce tax obligations without violating technical compliance requirements. Ms. Garcia, sales tax regulations are complex and allow for strategic reporting approaches that minimize tax obligations while maintaining technical compliance. Johnson continued with apparent regulatory complexity knowledge and strategic compliance expertise. Most retail businesses overpay taxes because their accountants don't understand advanced compliance strategies. Johnson suggested that Patricia could reduce her sales tax obligations by underreporting cash sales and certain online transactions that were difficult for tax authorities to track and audit effectively. Patricia was interested in legitimate tax minimization, but was concerned about Johnson's suggestions that seemed to involve underreporting actual sales and potentially violating tax compliance requirements. "I want to minimize taxes legally, but I'm uncomfortable with underreporting actual sales," Patricia explained to Johnson. "Can you clarify whether your strategies involve legitimate compliance or actual underreporting of business income?" Johnson became evasive when Patricia questioned his reporting suggestions, claiming that strategic tax compliance involved complex techniques that required professional expertise to implement without compromising business integrity. Ms. Garcia, strategic tax compliance involves sophisticated reporting techniques that ensure minimum tax obligations while maintaining regulatory compliance. Johnson insisted with apparent compliance expertise and regulatory knowledge. These strategies are completely legal and involve proper interpretation of complex sales tax regulations. Johnson also claimed that conservative tax reporting was costly for retail businesses and that strategic approaches were necessary to compete effectively with businesses that used advanced tax planning to reduce their obligations. Patricia felt uncomfortable with Johnson's vague explanations and decided to research sales tax requirements independently to verify the legitimacy of strategic reporting approaches that seemed to involve underreporting. Patricia contacted her state's Department of Revenue to research sales tax compliance requirements and learned that underreporting sales constituted tax fraud and could result in serious penalties and criminal prosecution. Patricia also learned that legitimate tax compliance required accurate reporting of all sales, and that strategic interpretation of regulations did not allow for underreporting actual business income or sales activity. Patricia realized that Johnson was proposing sales tax fraud by suggesting underreporting of actual sales while claiming that such strategies were legitimate compliance techniques. Patricia contacted Johnson to decline his services and inform him that she would pursue legitimate tax compliance through proper reporting, but Johnson claimed that her conservative approach would result in overpaying taxes. Patricia reported the sales tax fraud scheme to her state's Department of Revenue and Board of Accountancy. She learned that sales tax fraud often targeted retail businesses with promises of reduced obligations through strategic underreporting. The authorities explained that legitimate sales tax compliance required accurate reporting of all sales activity and that any suggestion of underreporting sales to reduce taxes constituted fraud regardless of claimed strategic justification. Patricia worked with a legitimate certified public accountant who provided proper sales tax compliance assistance through accurate reporting and legitimate deduction strategies without suggesting any underreporting of business income. The experience taught Patricia that legitimate tax compliance required accuracy and honesty in reporting business activity rather than strategic underreporting, and that accountants suggesting income underreporting were proposing fraudulent services. Patricia now educates other retail business owners about sales tax fraud and emphasizes the importance of accurate reporting and working with legitimate professionals who prioritize compliance over tax reduction through questionable strategies. Stephen, a 39-year-old technology consultant, was managing his business expenses when he encountered an accountant that would test his understanding of legitimate business deductions and teach him valuable lessons about deduction fraud targeting independent contractors. The accountant encouraged inflated expense claims to maximize tax benefits while risking audit penalties. Stephen operated as an independent technology consultant and needed professional assistance to ensure proper business expense documentation and maximize legitimate tax deductions available to independent contractors and consulting businesses. The accountant, Angela Davis, from Contractor Tax Maximization, specialized in independent contractor taxation and claimed expertise in finding maximum deductions that other accountants missed due to conservative interpretation of business expense regulations. Mr. Mitchell, independent contractors can claim much higher business deductions than most accountants realize through aggressive interpretation of business expense regulations, Davis said with apparent contractor expertise and deduction maximization knowledge. Contractor tax maximization ensures that you receive every possible deduction to minimize your self-employment tax obligations. Davis explained that business expense deductions for contractors involved complex regulations that allowed for creative interpretation and maximum claims that conservative accountants avoided due to lack of expertise in contractor-specific deductions. Mr. Mitchell, contractor business expenses include many categories that conservative accountants don't claim because they don't understand the full scope of legitimate business deductions available to independent consultants. Davis continued with apparent deduction expertise and conservative accountant criticism. My aggressive approach ensures maximum deduction claims that significantly reduce your tax obligations. Davis suggested that Stephen could significantly increase his business deduction claims by expanding categories like home office expenses, vehicle usage, meals, travel, and professional development to maximize tax benefits. Stephen was interested in legitimate business deductions, but was concerned about Davis's aggressive approach that seemed to involve inflating expense claims beyond actual business costs and legitimate deduction requirements. I want to claim legitimate business deductions, but I'm worried about inflating expenses beyond actual costs, Stephen explained to Davis. Can you ensure that your deduction strategies are based on actual business expenses rather than inflated claims? Davis became dismissive about Stephen's inflation concerns, claiming that aggressive deduction strategies were completely legitimate and that conservative approaches left money on the table for independent contractors. Mr. Mitchell, aggressive deduction strategies involve maximum interpretation of business expense regulations that ensure you receive every deduction you're entitled to as an independent contractor. Davis insisted with apparent legitimacy claims and entitlement knowledge. Conservative accountants cost contractors thousands in overpaid taxes because they don't claim maximum legitimate deductions. Davis also claimed that IRS audits of independent contractors were rare and that aggressive deduction strategies were unlikely to result in audit problems for consulting businesses. Stephen felt uncomfortable with Davis's aggressive claims and decided to research business deduction requirements independently to verify the legitimacy of maximum deduction strategies for independent contractors. Stephen contacted the IRS to research legitimate business deduction requirements for independent contractors and learned that business deductions must be ordinary, necessary, and properly documented with actual expense receipts and records. Stephen also learned that inflating business expense claims constituted tax fraud and that aggressive deduction strategies often involve questionable claims that could result in penalties and audit problems. Stephen realized that Davis was encouraging deduction fraud by suggesting inflated expense claims while claiming that aggressive strategies were legitimate business deduction techniques. Stephen contacted Davis to decline her services and inform her that he would pursue conservative deduction strategies based on actual expenses, but Davis claimed that his approach would result in overpaying taxes. Stephen reported the deduction fraud scheme to the IRS and his state's Board of Accountancy. He learned that business deduction fraud often targeted independent contractors with promises of maximum tax benefits through inflated expense claims. The authorities explained that legitimate business deductions required actual expenses with proper documentation and that aggressive strategies suggesting inflated claims constituted tax fraud regardless of claimed legitimacy. Stephen worked with a legitimate certified public accountant who provided proper business deduction assistance based on actual documented expenses and conservative interpretation of deduction regulations. The experience taught Stephen that legitimate business deductions required actual expenses and proper documentation rather than aggressive strategies that inflated claims, and that accountants encouraging expense inflation were proposing fraudulent services. Stephen now educates other independent contractors about deduction fraud and emphasizes the importance of claiming only legitimate, documented business expenses rather than accepting aggressive strategies that could result in audit problems. Michelle, a 35-year-old franchise owner, was reviewing her business financial statements when she encountered an accountant that would test her knowledge of legitimate financial reporting and teach her valuable lessons about financial statement fraud targeting business owners seeking loans or investors. The accountant offered to enhance financial statements to improve loan approval chances. Michelle owned a successful pizza franchise and was seeking business expansion loans that required comprehensive financial statements demonstrating business profitability and cash flow to support additional debt obligations. The accountant, Brian Wilson from Business Financial Enhancement, specialized in preparing financial statements for loan applications and claimed expertise in presenting business finances in the most favorable light for lender approval. Ms. Anderson, lenders often reject loan applications from profitable businesses because financial statements aren't presented properly to demonstrate true business value, Wilson said with apparent lending expertise and financial presentation knowledge. Business Financial Enhancement ensures that your financial statements showcase your franchise's strength and profitability for maximum loan approval potential. Wilson explained that financial statement enhancement involved strategic presentation of business income and expenses that highlighted profitability while minimizing aspects that lenders viewed negatively during loan underwriting processes. Ms. Anderson, financial statement enhancement involves proper classification and timing of income and expenses to present your franchise's financial performance in the strongest possible light. Wilson continued with apparent classification expertise and timing strategy knowledge. This strategic presentation ensures that lenders see your business's true profitability and cash flow potential. Wilson suggested that Michelle's financial statements could be enhanced through strategic timing of revenue recognition and expense classification that would improve profitability ratios and cash flow presentation for loan approval. Michelle was interested in presenting her business favorably, but was concerned about Wilson's enhancement suggestions that seemed to involve manipulating financial information rather than accurate reporting of business performance. I want to present my business positively, but I'm concerned about manipulating actual financial information, Michelle explained to Wilson. Can you clarify whether enhancement means better presentation of accurate information or actual changes to financial data? Wilson became evasive when Michelle questioned his enhancement methods, claiming that financial statement preparation involved complex techniques that required professional expertise to implement without compromising business integrity. Ms. Anderson, financial statement enhancement involves sophisticated presentation techniques that ensure proper classification and timing according to accounting standards. Wilson insisted with apparent accounting standard knowledge and proper classification expertise. These techniques present accurate financial information in the most favorable format for lender evaluation. Wilson also claimed that conservative financial statement preparation often resulted in loan denials for profitable businesses because standard presentation didn't highlight business strengths effectively for lending evaluation. Michelle felt uncomfortable with Wilson's vague explanations and decided to research financial statement standards independently to verify the legitimacy of enhancement techniques that seemed to involve manipulation. Michelle contacted a business loan officer to research legitimate financial statement requirements and learned that lenders required accurate, unmanipulated financial statements prepared according to established accounting principles. Michelle also learned that financial statement manipulation to obtain loans constituted bank fraud and could result in serious legal consequences, including criminal prosecution and loan default acceleration. Michelle realized that Wilson was proposing financial statement fraud by suggesting manipulation of financial information to improve loan approval chances while claiming that such techniques were legitimate presentation strategies. Michelle contacted Wilson to decline his services and inform him that she would pursue legitimate financial statement preparation, but Wilson claimed that her conservative approach would likely result in loan denial. Michelle reported the financial statement fraud scheme to the SBA, her state's Board of Accountancy, and banking regulators. She learned that financial statement manipulation often targeted business owners seeking loans through promises of improved approval chances. The authorities explained that legitimate financial statement preparation required accurate reporting according to established accounting principles and that any manipulation to influence lending decisions constituted fraud. Michelle worked with a legitimate certified public accountant who prepared accurate financial statements that properly demonstrated her franchise's profitability without manipulation or enhancement that could constitute fraud. The experience taught Michelle that legitimate financial statements required accuracy and honesty rather than enhancement or manipulation, and that accountants suggesting financial manipulation were proposing fraudulent services. Michelle now educates other franchise owners about financial statement fraud and emphasizes the importance of accurate financial reporting and working with legitimate professionals who prioritize compliance over loan approval enhancement. Thomas, a 32-year-old real estate investor, was managing multiple property investments when he encountered an accountant that would test his understanding of legitimate investment accounting and teach him valuable lessons about depreciation fraud targeting real estate investors. The accountant suggested excessive depreciation claims to minimize taxable income while risking IRS scrutiny. Thomas owned several rental properties and needed professional assistance to ensure proper accounting for real estate depreciation, maintenance expenses, and investment income to optimize tax benefits while maintaining compliance with IRS regulations. The accountant, Rachel Torres from Real Estate Tax Optimization, specialized in real estate investment taxation and claimed expertise in maximizing depreciation benefits and expense deductions that other accountants missed due to conservative interpretation of real estate tax regulations. Mr. Peterson, real estate investors can claim much higher depreciation and expense deductions than most accountants realize through aggressive interpretation of real estate tax regulations, Torres said with apparent real estate expertise and depreciation maximization knowledge. Real estate tax optimization ensures maximum tax benefits through sophisticated depreciation strategies and expense optimization. Torres explained that real estate depreciation involved complex regulations that allowed for accelerated depreciation schedules and creative expense categorization that significantly reduced taxable income from rental property investments. Mr. Peterson, real estate depreciation includes many categories and acceleration options that conservative accountants don't utilize because they don't understand advanced real estate tax strategies. Torres continued with apparent depreciation expertise and conservative accountant criticism. My aggressive approach ensures maximum depreciation claims and expense deductions that substantially reduce your real estate investment tax obligations. Torres suggested that Thomas could significantly increase his depreciation claims through component depreciation, bonus depreciation, and expanded expense categories that would minimize his rental income tax liability. Thomas was interested in legitimate depreciation benefits, but was concerned about Torres's aggressive approach that seemed to involve excessive depreciation claims beyond actual property costs and legitimate tax requirements. "I want to claim legitimate depreciation benefits, but I'm worried about excessive claims that might exceed actual property costs," Thomas explained to Torres. "Can you ensure that depreciation strategies are based on actual property values and legitimate tax regulations?" Torres became dismissive about Thomas's excess concerns, claiming that aggressive depreciation strategies were completely legitimate and that conservative approaches resulted in overpaying taxes on real estate investments. Mr. Peterson, aggressive depreciation strategies involve maximum utilization of real estate tax benefits that ensure you receive every deduction available under tax regulations. Torres insisted with apparent legitimacy claims and tax benefit knowledge. Conservative accountants cost real estate investors thousands in overpaid taxes because they don't claim maximum legitimate depreciation benefits. Torres also claimed that IRS audits of real estate investors were manageable and that aggressive depreciation strategies were unlikely to result in serious audit problems for property investment businesses. Thomas felt uncomfortable with Torres's aggressive claims and decided to research real estate depreciation requirements independently to verify the legitimacy of maximum depreciation strategies for property investors. Thomas contacted the IRS to research legitimate real estate depreciation requirements and learned that depreciation claims must be based on actual property costs and established depreciation schedules with proper documentation and cost basis records. Thomas also learned that excessive depreciation claims constituted tax fraud and that aggressive strategies often involve questionable claims that could result in penalties, interest, and recapture requirements. Thomas realized that Torres was encouraging depreciation fraud by suggesting excessive depreciation claims while claiming that aggressive strategies were legitimate real estate tax techniques. Thomas contacted Torres to decline her services and inform her that he would pursue conservative depreciation strategies based on actual costs, but Torres claimed that his approach would result in overpaying taxes. Thomas reported the depreciation fraud scheme to the IRS and his state's Board of Accountancy. He learned that real estate depreciation fraud often targeted property investors with promises of maximum tax benefits through excessive depreciation claims. The authorities explained that legitimate real estate depreciation required actual property costs and established depreciation methods with proper documentation, and that excessive claims constituted tax fraud regardless of claimed legitimacy. Thomas worked with a legitimate certified public accountant who provided proper real estate depreciation assistance based on actual property costs and conservative interpretation of depreciation regulations. The experience taught Thomas that legitimate real estate depreciation required actual costs and proper documentation rather than aggressive strategies that inflated claims, and that accountants encouraging excessive depreciation were proposing fraudulent services. Thomas now educates other real estate investors about depreciation fraud and emphasizes the importance of claiming only legitimate, documented depreciation based on actual property costs rather than accepting aggressive strategies that could result in audit problems. Lisa, a 38-year-old e-commerce business owner, was preparing for investor presentations when she encountered an accountant that would test her knowledge of legitimate revenue recognition and teach her valuable lessons about revenue manipulation fraud targeting growing businesses seeking investment. The accountant suggested accelerating revenue recognition to inflate business performance metrics. Lisa's online retail business was growing rapidly, and she was preparing financial statements for potential investors who required comprehensive documentation of business growth and revenue trends to evaluate investment opportunities. The accountant, Daniel Rodriguez, from Growth Business Accounting, specialized in preparing financial statements for growing businesses and claimed expertise in presenting business performance in the most attractive format for investor evaluation and funding decisions. Ms. Thompson, investors evaluate businesses based on revenue growth and profitability trends, and proper revenue recognition timing can significantly impact investment valuations. Rodriguez said with apparent investor evaluation expertise and revenue recognition knowledge. Growth business accounting ensures that your financial statements demonstrate maximum business performance for optimal investor interest. Rodriguez explained that revenue recognition involved complex timing rules that allowed for strategic recognition of sales and contracts that could accelerate reported revenue growth and improve business performance metrics for investor presentations. Ms. Thompson, revenue recognition timing involves sophisticated accounting techniques that can accelerate revenue reporting within acceptable accounting standards. Rodriguez continued with apparent timing expertise and acceleration strategy knowledge. Strategic revenue recognition ensures that your business performance metrics demonstrate maximum growth potential for investor evaluation. Rodriguez suggested that Lisa's financial statements could be enhanced through accelerated revenue recognition of pending orders and contracts that would improve quarterly growth rates and annual revenue trends for investor presentations. Lisa was interested in presenting strong business performance, but was concerned about Rodriguez's acceleration suggestions that seemed to involve manipulating revenue timing rather than accurate reporting of actual business results. I want to show strong performance, but I'm concerned about manipulating revenue timing beyond actual business results, Lisa explained to Rodriguez. Can you clarify whether acceleration means proper timing of actual sales or artificial manipulation of revenue recognition? Rodriguez became evasive when Lisa questioned his acceleration methods, claiming that revenue recognition involved complex accounting standards that required professional expertise to implement properly for optimal business presentation. Ms. Thompson, revenue recognition involves sophisticated accounting standards that ensure proper timing and classification according to established principles. Rodriguez insisted with apparent accounting standard knowledge and proper timing expertise. These techniques present accurate business performance using optimal recognition timing that demonstrates true business growth potential. Rodriguez also claimed that conservative revenue recognition often understated business performance and could result in lower investment valuations because standard timing didn't highlight business growth effectively for investor evaluation. Lisa felt uncomfortable with Rodriguez's vague explanations and decided to research revenue recognition standards independently to verify the legitimacy of acceleration techniques that seem to involve manipulation. Lisa contacted the Securities and Exchange Commission to research legitimate revenue recognition requirements and learned that revenue recognition must follow established accounting principles and accurately reflect actual business transactions and performance. Lisa also learned that revenue manipulation to attract investors constituted securities fraud and could result in serious legal consequences, including criminal prosecution and investor lawsuit liability. Lisa realized that Rodriguez was proposing revenue manipulation fraud by suggesting artificial acceleration of revenue recognition to inflate business performance metrics while claiming that such techniques were legitimate accounting practices. Lisa contacted Rodriguez to decline his services and inform him that she would pursue legitimate revenue recognition based on actual business performance. But Rodriguez claimed that her conservative approach would result in undervalued investment opportunities. Lisa reported the revenue manipulation scheme to the SEC and her state's Board of Accountancy. She learned that revenue recognition fraud often targeted growing businesses seeking investment through promises of improved performance presentation. The authorities explained that legitimate revenue recognition required accurate reporting according to established accounting principles and that any manipulation to influence investor decisions constituted securities fraud. Lisa worked with a legitimate certified public accountant who prepared accurate financial statements that properly reflected her business performance without manipulation or acceleration that could constitute fraud. The experience taught Lisa that legitimate financial reporting required accuracy and honesty rather than manipulation or acceleration, and that accountants suggesting revenue manipulation were proposing fraudulent services. Lisa now educates other e-commerce business owners about revenue recognition fraud and emphasizes the importance of accurate financial reporting and working with legitimate professionals who prioritize compliance over investor presentation enhancement.